Yeah. Good evening, good afternoon, everyone. Uh, Welcome to this session. On behalf of Khaitan and IVCA, we would like to welcome you to this session. I know you have, all of us have been in a lockdown now nearly for over 90 days, and I think we live in a very different world and really with a lot of uncertainty around us. Uh, and the private equity industry is no exception as well. And I think we've all kind of lived through this phase. Hopefully, I think we are starting to see the tunnel here in some form. And I think as we go along the session, we'll discover how the industry is kind of evolved in the last 3 months. But I think we thought it would be an opportune time now that we have the benefit of a hindsight of seeing this in the last 90 days or probably a 6 month of pandemic. Uh, Slowly, I think a lot of empirical evidences are emerging, and I think people have recalibrated themselves to this new normal. And that's where we thought it would be a great opportunity for us, and along with my partners here, Vivek and Divas, to really kind of share with you in terms of what we see the PE community and the fund managers doing in terms of dealing with the impact of this pandemic, and what are the different kind of mantras which have evolved. And I think it's always interesting to see how responsive this industry has been to the change environment. And as we go along over the next 45 minutes or to an hour session, you'll see how some of the trends and opportunities are emerging. We've also kind of going to lay down some of the commandments for the GPs based on what situations that we are experiencing for our clients, how the world has been evolving, LP reactions to some of this. So I think we do hope that this is going to be a interesting seminar for all of you. And just to kind of start off on an icebreaker for all of us, because we have been in this period of lockdown, I'm sure all of you have been attending a lot of webinars and even conducting a lot of them. So I think maybe we would want to start off with a first quick poll, and we'll have some poll questions through the session. But I think to start off, I just wanted to put up the first poll, which I think is about how many webinars I think each of us have been attending. So I think it would be interesting to see the reaction first. Can we have the first poll question, please? And this need not be a very mathematical answer to it, even a few polls. There you go. So we have the response. I think all of us have been a lot of webinars, and I think I can share the feeling of those last 23%. Even a few of them can sound very endless, and I think we've seen enough of the WhatsApp and other groups circulating on what effect the webinars have had. So I think between me and my panelist here, we will obviously keep that at the back of our mind and try to make sure that as an audience, you get your worth and we don't keep you bored and try to keep you engaged through this session. And I think with unfortunate timing of this whole pandemic, I think a lot of them, and we've all been working out of home for 90 days, and maybe I think a lot of our close ones and dear ones may not have seen us at home for such a long period of time and duration. And I think maybe let's also bring up another interesting poll as to what's the impact that work from home and what feeling you share at this point. Can we please get the second poll question quickly? sure. I think I can very much predict what the answer. There you go. I don't think that's a surprise. I think work from home had its own impact on all of us, and I think the holiday is something that we all need, and we do hope that that would be something that we get to enjoy in the near term. But I think with that, I think just jumping right into the topic, and can we have the slides back, please? So I think again, as I was mentioning earlier, that this 90 days have given us time to kind of really assess, understand the impact that the pandemic is having. And I think we are clearly seeing some emerging trend. And I think what we also see, the world, including the PE industry, is emerging more and more resolute to kind of see through this crisis, find opportunities within this crisis, and obviously deal with the situation at hand. And to kind of set the backdrop, I think, can we have the next slide, please? Can we have the next slide, please? Yeah. So I think, again, just quickly running through this unprecedented global crisis, and I think both in terms of health and economy, and we share equal concern for both, as does the government, and I think it's going to be an interesting time as to how the world sees through this crisis. Clearly, it's been unprecedented in many sense drop on the exchanges across the world, and India being no exception. So obviously a lot of billions of dollars of wealth getting eroded over the last 90 days, and the impact of that as we go along, we can also assess on the GPs and the LPs together. The oil prices, again, interesting phenomenon in a way, where we have pretty much everything going north, oil prices included, and yet I think the economy is still suffering. But in some sense, this has been a savior for us as a country, because it's kind of helped us and should help us in some form bridge the gap, the deficit that we constantly face. Obviously, I think we are still too early to assess the full impact of COVID. And it can only be assessed once we have the virus contained completely. We still seem to be some distance away, but very clearly, I think these 90 days to 180 days of learning has started evolving into some amount of wisdom for the industry, and I think we'll see that in the next few slides. And I think people have responded, as I said, quite positively to this. Either it means creating continuity plans, or I think people have recalibrated their approach. So I think the PE industry, to our experience, has really responded in the last few months, and I think we'll see the impact of that as we go along in the presentation. Next slide, please. So quickly, from a GP lens perspective, obviously difficult times from a fundraising, and I think we'll delve into it more detail as Vivek goes through different stages and the impact. Also, the people are starting to assess whether the commitment periods or the term of the fund would need extension. I think there's already some amount of regulatory action which is being proposed to allow to represent to SEBI, because you still sit on a dry powder, but maybe from a deployment cycle perspective, you may end up requiring a lot more time. However, we just came across one of the private equity international survey of about 120 funds and fund managers, and almost 60% of them felt that they're comfortable today that they may not need an extension. Now, obviously, this was probably a month old survey or a month and a half old survey, I think with the way the situation has been evolving, I think maybe this could change a bit. But by and large, there is a fair degree of optimism that we see. Uh, Also, while GPs are conscious about the fall in valuations of the portfolio, they are obviously making a beeline for attractive opportunities or to kind of reinforce their position in valuable portfolio companies. So that is one thing that we are seeing, and obviously a lot of them are actively and more proactively engaging with LPs, and Vivek will talk about it. And there is going to be some of them are concerned with the clawback triggers. So I think especially with those who have been seeing a deal by deal carry, we all know that model has become more and more remote in many sense for the GPs. But I think those who do have and have been lucky enough to have it, I think you should be preparing for a potential clawback in some situation. Moving to the LP side of the perspective, can we have the next slide, please? Very clearly, there is a worn down effect on the LPs. I think they have just been taking hit across the portfolios, whether it's public market, crude, currencies, and gold is probably the only other asset class. But I think there are enough asset classes which have been suffering, and LPs are definitely getting tired in a way to dealing with the crisis. It's also bringing potentially, we haven't yet seen any large-scale defaults, and that's a good news for all of us out here that a lot of LPs seem to be comfortable today that in spite of the crisis, they may be able to kind of honor their drawdowns. Also, likelihood of LPs utilizing a secondary fund facility, and I think that will be one of the trends that we'll see going forward, that those who need liquidity may actually look for secondaries, and this would be a great field for the secondaries to start becoming active, and LPs will be looking out for such opportunities. And I think we will, and LPs are in some sense mentally preparing themselves for an extended commitment period, or are also looking at a potential increase in the term of the fund depending on which stage that you are at as a fund manager. And I think very clearly increased reporting is what LPs are expecting across the world. And I think it's rightfully so because they want to be as much in control of the situation. And then just to kind of, before I hand it over to Vivek, just a quick survey which was done. Can we have the next slide, which gives us a good optimism to there you go. So while there hasn't been a tectonic shift in the investment plans of the investors as of now, again, a PEI survey shows that investors are definitely in a dilemma in respect to their commitment. So I think while you see on the extreme right, where you see kind of almost a status quo answer on a lot of these parameters, you do see enough number of LPs who are confused or have taken decision to whether it is to scale down their commitments to private equity or whether to reduce their co-investment activity, and then that's really where or be more flexible in terms of amendment or changes to the investment. So I think in a way this seems to clearly indicate that the LP community may still be a little confused, but I think as we go along, we'll share with you what we think each of the fund managers, depending on their state. So with that, I think I'd like to hand it over to Vivek to walk us through the next few slides, talking about the impact in more detail. Over to you, Vivek, please.
Thank you, Siddharth. Thank you. Good evening and good afternoon to all my friends. So the next stage of this presentation, what I will be taking you through is the stages of the fund based on where we see essentially they are in the various life cycles. So we basically divided the life cycle of fund into 4 stages. Stage 1 is inception stage, where the fund manager has sort of is starting to raise the fund, but he has not yet achieved the initial closing. So when we divided the stages, what we also look at is how is the COVID going to affect each of the fund managers in the various stages of the fund life cycle. The second is the deployment stage, where you have achieved an initial closing and are moving towards a final closing and are utilizing the commitment period. So the effects of COVID on those. Third is you have completed your investment period and you have a good set of portfolios, but on account of COVID, that portfolio is now affected. So what is the impact of COVID and what are the trends that we are seeing on from an operational phase? This would be typically 3 to 4 years from the end of the commitment period, assuming a 10-year life cycle. And the next fourth stage is basically the harvesting phase, where you are essentially looking at exiting all your investments. And there are a few funds, given that the AIF regulation is a 2012 regulation. So we would have a few funds which are at this stage where there was a good portfolio to be sold. However, on account of COVID, uh, exits are not looking possible, and we can look at the basically the effects of COVID on that. So we'll move to our next poll just to see. Uh, could you bring out the next poll, please? And it is to determine where we have the participants. We would just like to know which stage of the fund you are primarily involved in. So basically on the funds that the fund managers or the LPs, where are most of your funds situated? That is either inception, deployment, operations, or harvesting. Yeah. So majority of our participants are in the deployment stage, where initial closing has been achieved and we are in the deployment phase. Uh, Interesting. And given the increase in the AIF popularity of AIFs over the last few years, I mean, that was sort of the expectation also. Can we move to the next slide, please? From an inception perspective, what we would like to the inception stage would need to be broken up into two phases essentially. One is a first-time fund manager who's just moved into the market in the late end of 2019 and beginning of 2020, where he's looking at doing the fund. And the second category is the fund manager who is already in the market, and this is the second or the third fund. So we'll take the impact of essentially COVID on both the sets of fund managers. So from a fundraising perspective, we will start with the first-time fund manager. COVID has brought with it certain difficulties in terms of traction. Now with COVID, if you had started marketing in the second half of 2019 or the first half of beginning of 2020, there's limited traction which you would have sort of got with your LPs. And given the limited connects and placement agents not functioning as they would have, or even you going ahead and making your pitch meetings, we see this category as a category that would be largely affected on account of closing. So initial first-time fund managers on account of COVID can expect the fundraising to get significantly extended on account of the limited traction that they can achieve or they will be able to see with fund managers. And also what has not worked in their favor is existing, like if you've seen the report, there is certain tractions, like certain large scale GPs, etc., are refocusing on domestic markets. So to that extent, there is one set of a GP group which is already out or sort of coming out, is already out for from a fundraising perspective. And typically these are certain of the concerns which are affecting the fundraising for our first-time fund managers. However, when we look at more established fund managers or somebody who's looking at a second time, he's looking at the second fund, we have seen that given the traction that they have already achieved in the first fund and their established relationships, and assuming the marketing had commenced in 2019, we are seeing these funds fairly being able to achieve closing. And based on our experience, this is one set of investor or one set of fund managers. In the next quarter, we will see a lot of them announcing their initial closes, at least based on existing investors. There's not significant new money from new investors, but the existing investors is what we see are committing to these funds. Can we move to the next slide?
Yeah, just to add to, I think what Vivek just mentioned, and sorry to interrupt, Vivek. I think by and large our experience for these categories of fund managers who've been on the fundraising side, we haven't really seen a lot of them pull back their plans. And I think most LPs where they have been in engagement, I think by and large the impression that we carry is those LPs have continued with their commitment. So I think generally we haven't seen a large degree of scale back or launches being called back. But yes, there are exceptions and we've seen some of those, but by and large we haven't seen much of a. So that gives us some hope that LPs are still looking at India as an asset class which may still look attractive for them. Sorry, Vivek.
And just to add to what Sid and Vivek were saying, I think traditionally when we see the fundraising scenario, you'll broadly divide the LPs into two buckets. You'll have your regular HNI LPs and you'll have your institutional LPs. Now, traditionally, closing funds through HNIs has always been easy. But of late, at least what we have seen because of the corona pandemic and certain perceptual issues, it is actually the institutional LPs which continue to show their commitment for the funds which they have broadly have their strategies aligned with, and of course towards India in the longer run. And it is basically the HNI LPs which may be shying away. So I think, from the GP perspective, who's out there raising funds, it could be important to target both the HNIs as well as your institutional investors, because it is actually the institutional investors who would essentially have a longer term play and would have a longer term commitment, and it may be easy to tie them in at this stage.
That's right, Divas. Yeah, so I think to summarize that, it's going to be a difficult market for first-time fund managers, and it's essential that you have your, if you have any established connects, you should pursue those, because those are the guys, given the COVID time where travel and traction is limited, they will be the people who would be ready to commit to you. And typically, when you are a first-time fund managers, you would have your HNI connect, but given the fall in the market, I don't know how much traction we can expect from the HNI segment, at least for 2020, until like there is significant progress in the markets and the business pickup. So we move to the next. Step of Inception, or this stage one, from a SEBI registration perspective and from the application perspective. So what we've seen is that SEBI has been working as usual. So it's business as usual in SEBI, and the application process continue to basically follow the timelines. And we've seen COVID actually bring out certain amount of efficiency. So SEBI has been working round the clock. So be it a weekday or a weekend, we've been seeing emails from SEBI on that front. So practically COVID has at least got one good news, that the market regulator is on top of its game. Yeah. Can we move to the next slide? Next slide is just a short survey which was done by PEI again. This was before the COVID and the global lockdown. So this sort of showed while the COVID had started showing its impact in China and Southeast Asia, but Europe and US were largely unaffected, and including India were not affected at that time. So while 66% have said that they have appetite for fund managers, first-time fund managers and debut fund managers, given the recent trend and how COVID has progressed, this bar would actually see a reduction of interest or appetite for first-time fund managers. Yeah. Can we move to the next slide? Also from an India perspective, the next slide, what we want to showcase is that there is a significant amount of dry powder already available in India. So to that extent, the exposure at an India level is quite high. If you look at 2018 and 2019, while the deal activities were limited in 2019, it's approximately about 20 billion of dry powder which is available with Indian funds for investment. Can we move to the next slide? Next phase of a fund life is stage 2, where we spoke about it's post the initial closing and somewhere between it's prior to the final closing or and up to the commitment period. So this is an interesting phase, and most of our participants are somewhere in this phase of the fund's life cycle. So when we look at funds at this life cycles, I think considering the boom in the AIF industry, most of our funds are in this life cycle. And given COVID, logistically, it has become, logistically, it's become difficult to travel. However, we have been seeing deals happening. So on a good part is deals are happening. It's all shifting to virtual data rooms, virtual due diligences to that extent. So to that extent, there is opportunity for dry powder to be utilized at this phase. However, from a fund manager perspective, in terms of where you've just completed your initial closing, but you still want to raise more money, certain of the concerns which we thought were important and which we've seen which have been raised is concerns over LP defaults. While you may have achieved your initial closing, but there is still a high level of concerns whether the LPs will be basically honoring their drawdown notices. Second is given the loss of time and including travel restrictions and tractions that you may have with investors, a lot of you would be thinking whether you should go ahead with a increase in your final closing time period, or you should shift the time period for your final closing. And similarly, it goes with your portfolio, it goes with your commitment period. Also, at the same time, while some of you may have made investments, that's going to really, the valuation of those would affect your future fundraise in case you have not achieved your final closing. And also the difficulty of how you would showcase or basically get new deals to the table given the travel restriction. So this is broadly what we will cover in stage 2 and sort of showcase to you what are the trends and expectations from an LP perspective. Can we move to the next slide, please?
I think just to add to that, Vivek, I think what could also be interesting for GPs to consider, because if we see the final closing, and if some of the GPs were at the last stages of closing out some LP commitments, and the final closing date was just around the corner, it could also be important to assess whether they really want to extend the final closing date, because then it has a spillover effect on the commitment period and ultimately on the term of the fund. Or if they were anyways to go back to their LPs, could they potentially look at a situation where they don't change the term and commitment period, but when they know that they have the LPs lined up and it's just a matter of a few weeks or a few months, can they just get a small carve out from the existing LPs for them to accept additional commitments within a defined period instead of extending these dates to which the LPs may have a greater concern, rather than just allowing their GPs to extend at least gathering money and not change the final closing.
That's right. That's right. So we'll move to our next poll, essentially to discuss whether basically if meetings and tractions, basically physical travel has affected fundraising or not. Can we move to the next poll? So do you think funds? Okay, sorry. I think it would be the next question. Next poll post, please. Yeah. So do you feel the absence of physical meetings and pitches have affected fundraising? Okay, interesting. So yes, as we have been discussing, significantly, I think fundraising plans for investors and for fund managers have been affected by the travel restrictions of COVID, and virtually is not as good enough as a physical pitch meeting. Can we move to this next slide? So I think, sorry, the slide 11. Yeah. So historically, the fund industry in India has witnessed very low. I would say the default rates haven't been fairly high. Even when you come to institutional investor have been almost negligible. But even when you come to HNIs, the rate of default has been very low. If we were to look at it, it would be as low as 2 to 3% across the industry and for a fund. However, with the looming crisis, there is fear that that the default rates would increase, and with the lockdown opening up, there is a fear amongst GPs that there may be an increase in the lockdown. However, during the lockdown period, we at least practically haven't seen too much concern around defaults by LPs. Uh, However, what we have seen is that this is the time where, in order to ensure that, given that you have achieved your initial closing or your final closing, there is a requirement for more interaction with your LPs to understand what their needs are and ensure that you balance the drawdowns for your investments based on your LPs requirement. So what a lot of funds that we have seen and what we are advising is that you come out with a drawdown schedule. So you have to lay down your drawdown plans across the next 6 to 12 months and sort of have a frank discussion with your LPs, because that's what you need at this point in time, to ensure that you are able to, basically, given the valuations, you are able to make those attractive investments. At the same time, you are able to accommodate your investors, basically meet the drawdown requirements. Also,
to this over here, just to sorry to interject. I think this is also an ask coming from LPs for them to manage their own cash flows better, because I think in a normal times where they would have been comfortable dealing with a drawdown on as needed basis. I think the current times, as we discussed, that LPs have faced significant erosion across their portfolio and also from a liquidity perspective. So this is one of the other reasons where we are starting to see a lot of LPs really willing to back the GPs through the drawdown period, but subject to them giving them a very clear path to deployment in some sense and plan, so that they can at the back end manage their own liquidity better. So this is something you should start engaging with, and this also creates a much better alignment and trust between the GP and the LP to that extent. Sorry, Vivek, back to you.
that's right, Siddharth. And I think especially you would have to look at your own funds composition. While you may have institutional investors and you typically wouldn't expect them to default, but uh, they also expect, they are even required to meet their liquidity and see their liquidity over the next 6 to 12 months. This is a big demand from them. And if you are a fund which has significant HNI investors, it would be very crucial for you to go and speak to them to ensure that there is no default on their part. Otherwise, that could hurt the fund in a big way. Can we move to the next slide? So LP defaults, we'll just take you through this. Under the AIF regulations, I think when we are dealing with LP defaults, under this slide, what we essentially want to showcase is what are the options available for for a GP while dealing with LP default. This is strictly under the AIF regulations, where there are restrictions on borrowings, etc. So if you have an overseas fund, there would be certain more flexibilities in terms of leverage, etc., to meet certain of these requirements. So under the AIF regulations, you have limited borrowing opportunities, so which is limited to 10% of your fund corpus and not for more than 30 days. So in case there is a big investor defaulting, that will actually affect your that will affect the entire drawdown and will also affect your deployment plan. Similarly, I think most of the fund documents in India where you have institutional investors, there is a restriction on bridging the gap between, there's a restriction on bridging the gap in case of a default. So that bridge is restricted to basically approximately 20 a minute. Yeah. Okay. So given all of these restrictions, it may be important based on your discussions with your investors to determine whether you want certain flexibility around certain of these terms, essentially terms relating to additional drawdowns from investor in case of a default or to bridge the gap. That would be something which you would have to consider. Can we move to the next slide? In this slide, we just want to showcase it's typically to list down what are the boilerplate GP remedies available in case of default. One is you have the right to extend your drawdown notice period, or basically the cure period is something which you can give. See, we've graded it into 3 buckets again. Green is the okay to do, yellow is a little bit more stringent, and the red is the harshest of them all, which is typically taken in extreme situations. So this is, you would have to be mindful based on your relationships and also what your fund documents provide for GP default, LP defaults. So the green is the first step which you would want to first exercise. That is in terms of
Vivek, we've lost you there.
Sorry, Vivek, we lost your audio for some reason.
Sorry.
Yeah, maybe we'll just.
So I think what we want to showcase in this slide is just the boilerplate GP remedies available. We've sorted them into 3 buckets again: green, yellow, and red. So given the COVID situations, we would have to act more practically, and we would typically want to fall under the green bucket, which is give them a cure period and discuss with them what sort of leeways, etc. they require. If they require more time, you may have to consider that depending on the nature of the fund documents that you have, or in the meantime, at least suspend the rights so that you give comfort to the investors that you have taken certain actions and you are looking at getting this money. Otherwise, what you could risk is you could risk having large-scale defaults depending on what the market condition is. The yellow and the red are more severe conditions in terms of withholding of distributions, secondary sale, etc. And red is the extreme harsh situation where you take an extreme call that you want to actually profit and basically suspend the operations or any rights of the defaulting unit. We move on to the next slide. So while the first phase, we essentially of the stage 2, we dealt with LP defaults. In the second phase of this, what we want to talk to you about is extension of commitment period whether that has an extension effect on the life of the fund, including extension of your final closing date, like Divas mentioned. So I think a lot of you, given the travel restrictions, are facing issues with regards to fundraising plans. So from that perspective, the fund documents, you need to examine your fund documents and see whether there are any flexibilities around that. In terms of extension of fund life, that is very straightforward under the AIF regulations. You need 66%. However, in terms of the commitment period and the final close date, in case you want to go and extend that, you would need to look at your fund document. Typically, this is something which you should be able to do with an LPAC approval or with a 75% consent. But at this stage, it is important that you go ahead and you have to go ahead and get a investor consent. Otherwise, there would be a default on your part. Can we move to the next slide, please? So we just, given that we've spoken about extensions, the typical process, what we wanted to guide you on this call was the process where you seek the extension in case of your final closing or your commitment period would be, you would need to basically list down the reason for the extension and send a request to the investors, give them at least 30 days to respond. And on the basis of that, you would have to circulate the revised documents to them and get their signatures and intimate it. So it's a 4-stage process in total. And this stage would approximately take you at least 30 to 40 days to complete. Next slide, please. So so we move to stage 3 of the fund life cycle, which is the interesting phase, I think, for certain of the funds where the commitment period has basically got completed and you are looking, and at least till the end of 2019 or basically the first quarter of 2020, you were looking at follow-on investments. However, that situation has completely changed, and what as a fund manager you would need to do is, given that you're faced with this unusual situation of COVID where everything is into a standstill, you would need to look at your portfolio companies, and instead of a follow-on investment, you would have to see and determine to what extent they require rescue financing. So, more like you would need to see which companies and examine which companies you can let go of, or which you can finance in order to ensure that there is a protection in value. So this stage, I think, is crucially is important from a marketing perspective, as opposed to basically from like the previous stages, we were more reliant on the investors to fund us and basically meet the drawdowns. But this is more, as a fund manager, you need to examine where the portfolio company is, and this would require additional monitoring on your part. Can we move to the next slide? So the next slide, what we sort of seek to cover is, with the slowdown in the economy that we have witnessed over the last 2 years, there is sort of a slowdown also in the exits which have happened. And going by this trend, even in 2020, we can expect a slowdown in exits, or basically we would be in a situation where the valuations, you wouldn't be meeting the valuations of 2019. We go to the next slide. Can we move to the next slide? Yeah. So I think while we are looking at it from, while we looked at it from an operational perspective, and basically exits, what we can determine is that exits on account of COVID have been pushed by over 2 years. So what we were looking at exiting in 2021 will have got pushed to 2022 or 2023. So typically, I mean, given the life of a fund, we would be reaching a harvest stage at that point in time where your portfolios are ready to exit. But given the COVID situation and the assets which you were looking at selling in the near future, fund managers are sitting on assets which now on account of COVID is you cannot sell it at the right price. So you are holding on to the assets and you would be stuck with those assets. So at this stage, I think the practical factors which a lot of you need to consider is what sort of extensions are you going to require to essentially look at making those exits, and whether there is a possibility of the portfolios turning around. So some of the practical considerations which you would need to do as a fund manager is seeing whether you should wait for your funds, whether you should wait for the portfolio to mature and give it 2, 3 more years, or whether you would derive the right value at this time by selling it all off, or basically look at secondary options to that extent. Can we move to the next slide? I would hand it over.
Thanks, Vivek, for the wonderful insights, and thanks, Sid, for the great initiation. I think just covering a few additional slides, of course, force majeure. Isn't this the most hotly, interestingly debated topic of this year, at least in the legal circles? I'm sure many of you would have attended various seminars, read various reports, articles, etc., on this topic. I think it'll be important for us to see how force majeure as a concept impacts the GP-LP relationship, and it impacts the funds. Force majeure wouldn't go into too much detail since a lot of you may already be aware. Force majeure is essentially the impossibility of performance or the frustration of a contract because of certain extraneous situations or circumstances which are not within the control of either of the parties to the contract. Now, if we consider, the key relationships in a fund, it is essentially the limited partners, which are the investors, and of course the fund manager or the general partner. In case of investors, their prime obligations to the fund are, one, of course, ensuring that their reps and warranties, their legal status is unchanged, their KYC is up to date, and of course to fulfill their part of the bargain, which is fulfill the capital calls from time to time. Now, how does force majeure affect them in these situations and circumstances? Particularly for capital calls, we have seen certain situations where, for whether it is corporate LPs or certain institutional LPs, because of the lockdown, because of their inability to access their computers, their systems, and their offices, capital calls have been delayed from certain LP side. So I think it's important to assess this particular aspect, and whether, of course, in light of the fact, do we as GPs have a force majeure clause in the document, how it has been drafted, what are the kind of specifics which have been provided as force majeure, whether lockdowns, whether pandemics have been covered or not. Even if it has not been covered as a concept, force majeure is always and is already there within the broad tenets of the Indian contract law. And the courts will need to see if at all the relevant party to the contract, which is an LP in this case, in such a situation, was in fact hindered in terms of performing their obligations, which is giving the GP call, so which is giving the capital call, for which they should not be held liable. Again, from a GP's perspective, I think it is very crucial to understand this also from a GP lens, because it is the GPs which essentially manage the fund, do the deployments, make the reportings, ensure that the fund aligns with all its regulations, ensure that the managers are meeting with the contractual obligations vis-a-vis specific LPs, particularly in light of reportings, particularly in light of giving certain specific insights to the LPs. And if any of those obligations which the GPs have agreed to under the fund documents, under the specific side letters with LPs, if any of those obligations are in fact being impacted, it is very important to see, how at least the agreements are drafted, whether they provide for a force majeure. And if even if it does not, I think it is important to at least pick this up and see whether the GP has faltered or somewhere has missed on any part of the obligations, and at least to bring this to light to the LPs to show that because of these specific reasons, which the GP could not fulfill their part of the bargain. Just moving on to the next slide. Sorry, you have.
Yeah, just to add to, I think, what Boris just mentioned, and I think this has been a hotly debated question across all contracts. And I think by and large, from a fund contract perspective, based on our experience, one, it's not very common that you see a force majeure contract into your subscription agreement or a contribution agreement. And to that extent, from a GP perspective, and then based on our empirical kind of study across contracts that we have seen, I don't see this to be a very common clause, except in case of certain DFIs, where they have been conscious enough to put in or bring in a force majeure clause. So very important provision for the GPs to look into it. Second, in absence of a clause, and I think relying on the Contract Act, Section 32 for frustration of a contract, I think the thresholds are significantly high. So when a one-time performance contract, where a situation like this may kind of lead to non-performance by an LP, is slightly different, because unlike other performance contracts, in this there is a continued non-performance which needs to be demonstrated for a contract to be really be seen as being frustrated. And that, obviously, with the current scheme of things, it's not going to be easy for an LP to say that when I have a 5-year or a 3-year commitment period, maybe a default here or a situation here would have kind of continually deterred their position over the entire commitment life to really take reliance on this frustration of a contract. So I think the message, I think, is largely that for funds contract, unless you have explicitly covered the situation and the impact of this force majeure, it's not going to be easy for LPs to really enforce this. And this is not just in India. I think that's also the global outlook from most international legal perspective as well. So that
Yeah, and very interesting perspective, I think. Just to add to this, and perhaps Vivek and Sid, you also pitch in. Where I feel this impacting the most, and our GP friends on this webinar, they would be better suited to tell us, how they essentially have been impacted, because like I said, there are various obligations on the fund manager, whether from a reporting, whether from a valuation, and particularly if you have institutional investors, whether DFIs, etc., they want various, like a zillion things from the GP from a time-to-time basis. Whether this pandemic, whether this lockdown, and any inability on part of the GP to fulfill any of their obligations to the LPs under the relevant contracts, whether that could trigger, and this could be a sensitive issue, whether that could trigger a removal of a key person based on any material defaults of the constituent documents of the fund. So I think that's we need to analyze this, and if at all there have been any mishaps like that, we should carefully study those mishaps and try and at least bring the investors up to knowledge with what has happened and get their buy-in in terms of if at all any of these have been flipped so far as performance of the GP on their part is concerned.
Yeah, absolutely. I think I think we may want to get a poll on this point from the audience. I mean, we've shared what we've seen largely, but it would be interesting to see how the audience feels about this provision. So can we have the poll on the screen, please? And I think obviously it has a philosophical angle to the question, but again, depending on the which side of the table that you are, I mean, it would be important to kind of there you go. So I think we seem to have a reasonably balanced kind of breakup, as I can see. So, which represents that there are clearly LPs who are also participating over here. And to that extent, I mean, I think, yes, the message is pretty clear. I think if you are, and maybe the world going forward will be very different, because I think maybe a lot of them may not have envisaged the situation that we are seeing today. And maybe LPs will get smarter, in some sense wiser with the situation. But I would still feel philosophically, for a fund which has a longer term commitment, and you are looking at a 10 to 20 year, 15-year kind of partnership, I think it could become slightly more difficult and challenging, not just for the fund manager, but also for other LPs, because I think enforcement of this clause and the consequences thereof could also have a far-reaching impact on the fund as a whole. So I think it's something where one might need to take a lot more considered view on this. But yeah, I think there was maybe back to you for the.
Let's shift to the next slide. Of course, now coming to the commandments for GPs during and post the COVID era, I think all three of us panelists at least are great. We're not pessimists. We look at the brighter and the silver lining at the end of it. So, what could be the positives which could come out of this pandemic? Let's analyze a few of these. I think the first one being efficient utilization of capital and existing resources. Depending on, as Vivek discussed, the various life cycles of the fund, depending on whether you're within your commitment period or after the commitment period, there are recycling or reinvestment clauses in the fund documents. Instead of burdening or in fact calling additional capital if there is an exit down the line, and we also have an opportunity, perhaps it may make sense marrying the two, where instead of doing a fresh capital call from LPs, we could look at reusing and recycling the exit proceeds which come out from near future exit. The second is rescue financing, which is also typically known as follow-on investments. Now, being an existing investor in a portfolio company, and various companies are going through a downturn, are may find it difficult to survive, and may need some capital to essentially keep their businesses running, to keep their capital going. Now, at this stage, if they were to raise third-party capital, the new investors coming may not be as sympathetic to the business and to the business environment, and may potentially come in at valuations which could significantly impact the liquidity, or rather the current shareholding pattern, where you could, as an investor, be significantly diluted. In such situations, it may be preferable for existing investors to basically look at follow-on investment clauses in the fund documents to see whether they can invest additional capitals in portfolio companies. And these clauses typically come in handy, particularly after the commitment period, where we've seen at times, though there are certain limitations on follow-on investments being made, which we've seen between 15 to 30% for follow-on investments. But at least if the fund documents do provide the flexibility, you may take the benefit of such clauses and supplement your existing portfolios to that extent. The third is, of course, I think all of you may be well aware, valuations being at an all-time low, cash is king. Whoever has cash, whoever has capital, whoever is sitting on commitments, I think this is the best time to go out there and buy and invest. A lot of great companies could be available at fantastic valuations. So definitely for GPs who are in the first cycle, or rather the second cycle where they've raised commitments, this could be a great time to invest. Just moving on to the next slide, please. I think currently it may also be important and pertinent for GPs to analyze their fund documents, particularly for some of these following specifics which we're covering. In light of what we discussed under force majeure, if LPs are stretched for liquidity, if LPs are stretched for fulfilling their capital commitments, They could look at various, rights which they have under fund documents to essentially either not put in the capital call or delay the capital call for different reasons. One of these rights is what we typically call the excuse right. Now, of late, while SEBI has been insisting that excuse rights could only be given for regulatory or tax reasons, but in the past, we've seen various large LPs at least negotiate a generic excuse right, where if they feel for whatever reason they're not comfortable making an investment, they may ask for being excused from the drawdown for this particular investment. So at least funds which were set up and which had negotiated these clauses 2 to 3 years back should definitely relook at their excuse provisions, whether under the fund documents or in the relevant side letters, if they've given out any generic excuse clauses. The next bit was, we've got various of these questions that traditionally GPs have been sending reports and notices in physical through couriers, etc. I mean, we're all living in the 21st century. By all means, feel free to utilize technology to the best of its capability. And in these times, we've seen most GPs use emails, use data rooms to transmit reports, to transmit any calls, to transmit any sort of approvals which they may need from the investors. It is absolutely fine, and typically your agreements with your LP should provide for a notice clause via emails also. That should be absolutely fine. The third is we've already discussed force majeure and risk factors. One is, of course, analyzing force majeure from an LP lens. The second is also analyzing force majeure as an investor in portfolio companies. Whether there are any specific force majeure clauses which are there in the investment agreements, which could potentially preclude the investee companies or their promoters from delaying, or impending any specific exits, any obligations which they may have under the investment agreements. So it may be important to pick those up, analyze, assess what risks could there be to the fund from these force majeure clauses in the investment agreements, and perhaps keep the LPs also informed of that. Coming to the next point, I think risk mitigation measures. It is like we've been discussing, and like Vivek and Siddharth also highlighted, I think this is a special time for all of us. At least for me, I have never seen a situation like this in my career, and most of us would not have seen. We're all grappling with a situation like this for the first time. So it's at least important to keep all LPs appraised of this, let them feel included, in the fund scheme of things. If there are any specific risk factors considering, the strategy of the fund objective, the kind of investments the GPs have made, it may be essential to at least pick up some specific risks from our current investee companies, or from a process perspective. If any particular risks are being highlighted when as GPs we run the process internally, I think it's important to keep the LPs appraised of these specific risk factors so that they are, tomorrow there should not be a question that this was a very unique situation and the LPs were not kept informed. I think the last on this slide at least was about e-execution. I think most cross-border GPs who've done cross-border investments would be quite used to this. E-execution, digital signatures are fairly common. Stamp duties, we've been able to obtain stamp papers from banks are still functioning, though it's leading to some bit of delay. But there's otherwise been no concern in terms of procuring stamp papers. And of course, all forms of agreements can be digitally signed and can be executed online with signature pages exchanged. Can we move to the next slide, please? Of course, I think the last slide, at least from my side, is investor relations. It's like we discussed, it's investors are kings because without them, there is no fund. We do all of this to keep the investors happy, to ensure that, from first to the second to the third to different strategies, our key investors continue, to be with us at all times. So the GP should take some of these key measures to ensure that, the investors and the manager are on the same plane. One is, of course, increase the interactions. whether through webinars, whether through calls, whether through additional reportings, ensuring that there is that communication and dialogue which is open with the investors. Because at the end of the day, I think these are uncertain times. Investors are also confused. Investors are also overcautious about what is happening on the ground, what is happening with portfolio companies. How are funds doing? How are managers reacting to this? I think so. It's very essential, from a manager perspective, to keep their investors included. Last is, I think Vivek has already covered this, to have some sort of a drawdown schedule, because honestly, there has been a massive liquidity crisis which many investors have faced. If they are appraised of a potential drawdown in the coming 6 to 12 months, they would be able to manage their liquidity internally fairly well, and you could potentially see reduced risks of LP level defaults in such situations. So I think it could be wise to at least see the horizon of deals we may be looking at, to see the horizon of expenses which may come up in the next 6 to 12 months, and keep the LPs appraised that this is the kind of drawdowns which as a GP we may be looking at in the foreseeable future. Just moving on to the next, there's a short poll which PEI had conducted. I think this could become the new normal of business, rather than physical meetings, whether it is investor meetings annually, or it is fund level due diligence, face-to-face meeting with LPs, or it is investor conferences. I think a majority of the persons across these three queries have responded that they would be more comfortable attending these over internet or over a technology media rather than in person. So I think that could be a new way of normal. That could be a new way of life for us going forward. I think having said this, I'll hand this over to Sid for his concluding remarks. Just can we move on to the next slide, please?
Yeah, so thank you, Devas, for walking us through the commandments for the GPs. I think a lot of learning, and probably I think the way we do business is going to change. The way our LPs expect us to do business is also going to change. And I think it's only upon us now to respond to the change and the new normal. Now, within this, obviously, any change brings with it a lot of new opportunities. And I think it's really where we see the crisis has obviously triggered a host of opportunities that GPs can capitalize on and are starting to capitalize on. And I think that is really where we wanted to also kind of leave you with some of the trends that we see are coming. And of course, before we part with you on this, we'll also want to understand from your perspective as well. So maybe I think if can we have the last poll, and then maybe I can run through some of these trends more clearly. Yeah. So I think we're seeing obviously newer strategies, newer formulation of pool structures versus platforms, opportunities around in distress. So it would be interesting to see which one seems to be. Of course, you'll see all of them, but obviously distress fund, and not surprisingly at all, we have seen a continued interest. So I think it's not a trend which has been triggered necessarily by COVID, because we've seen distress funds kind of making the beeline over the last 3 years. But obviously the situation that we are in, and with the anticipated default, we are likely to see a lot of them become more and more active. A lot more LP commitments may also go that way on the distress fund side. So maybe if you are developing your own strategy, I think that may be something where you may either focus on this or create certain opportunities like special sit investments. And that would be something that we are seeing as a trend going forward. Obviously, one of the few other trends, I think we have seen the debacle in some sense on the mutual fund side, especially on the debt side of it. And I think a broader thought process that seems to be evolving, and then maybe in the near term to mid-term, is that maybe alternative asset managers and you need a lot more specialized skill set for assessing the credit risks. And maybe that's an asset class which may be more suitable for alternative assets as against traditional public funds. And I'm not saying that debt mutual funds will disappear, but I think with the concentrated risk now within the SME segment, a lot more opportunities may get capitalized upon by the alternative funds. And we are definitely seeing an increased number of credit funds and inquiries relating to setting up of credit funds. So that's one. Second, I think we are seeing some shift now from a blind pool traditional structures to a lot more co-investment kind of preference from especially larger LPs. So obviously they want to be in much better control over the investments, and hence a platform deals are likely to see a growth in the current time. So maybe looking for those partners for yourself would be something that would be worth investing time in. I think this is we've talked about. Also increased activity in the secondaries fund, and I think while we haven't yet seen that action kind of take off, but all ingredients seem to be right, and then that's where we will see, and by some estimate maybe the next quarter or the quarter following that, we are likely to start seeing a lot of secondary portfolios coming to the market, and then maybe that would be a trigger for a lot of the secondaries fund to also get in. Of course, from a sector attractiveness, I think software and more traditional entities will continue to remain attractive. And then some of them may also, with the current crisis, become even more attractive as people kind of shift their cost base. So we've heard about all the software companies making work from home as almost a mandatory model, and that could lead to a significant amount of cost saving. And especially when you're looking at IT-enabled services, every reduction in a cost base is likely to make them more and more profitable. So I think that may be one of the trends where you'll continue to see that. And then fintech, I think the finance sector in general going through a lot of stress, and it may continue over the next couple of years. But I think this will also trigger a whole host of opportunities for fintech companies who are going to equip a fund manager or are well equipped to assess the credit risk in a more sophisticated way. So I mean, that may be the other opportunity that you will see coming up. And then, yeah, I think the last one, as I said, is really about the institutional platforms. And I think we should, and we have seen, even in the most difficult period of this pandemic, I think a lot of large institutional capital have kept their faith in India. And I think for them, it only removes a lot of, and India probably will remain amongst, is expected to be one of the few economies around the world which may potentially see, even if it's marginal, a positive growth. And that obviously puts us in a very attractive bracket as an asset class for pension funds, endowments, sovereign funds, and others. And the government, on the other hand, has obviously recognized the opportunity. So we are likely to see a lot more interest from these institutional investors, and trigger for a lot of institutional platforms across asset class, whether it's credit, real estate, distress, and then probably even more managed accounts out from there. And I think I know we've come to the end of our session here. We've obviously kept it open for any questions that you may have, and you're free to kind of raise any questions. We have got a couple of questions coming in, but we are also mindful of the time, and we not want to be one of those endless seminars, webinars where your interest kind of dwindles. So I think we'll just quickly have a couple of questions that I can take up, and if you have any more, please do end up posting. Also, one is the question, I think, you can probably respond to that. I think one of the question has been whether it has allowed epistolization and do away with the requirement of for foreign documents to be apostilled now. So I think I don't know. SEBI has definitely created a framework to allow seamless operations, but I think some of it will be an important. I mean, any thoughts, Devas or Vivek, that you may have on this?
Yeah. So no specific exemptions per se on apostolization. I think SEBI has, while they've granted certain exceptions for FPIs, at least from an immediate perspective for KYC requirements, etc. Unfortunately, no specific exemptions have been granted for KYC requirements for AIFs at least. So if these are foreign documents and if these, from a KYC perspective, if they need to be apostilled, we need to go down that route at least for the time being.
I think but we are using a lot of platforms. I mean, execution. So while we have continued to see fundraising activities, I think obviously execution of contracts and contribution agreement it has become a challenge from a stamp duty perspective or execution perspective. But having said that, I think especially when you're dealing with just from a practical perspective, I think if you're dealing with global investors, I think it becomes much easier if you have an offshore feeder. So there obviously there's been a less of a challenge for creating online execution. For domestic, for onshore contracts, even from a stamping and other perspective, you do have the ability to stamp these documents within a period of typically 90 days under the Stamp Act. So even if you execute online, I think you may have certain period, and I think there has been already a representation made to the stamp authority to provide for a grace period for this. So we would think practically you may not necessarily delay the execution, but yes, I think, and from an epistolization and KYC perspective, I think SEBI would be fairly considerate in this, though no formal announcement has been made for AIF, but I think they would be more considerate given the situation here. I think one interesting question which has come up and I think is on the top of the mind for all of us and the industry, what are the implications of the press note 3 on the alternative asset industry? So it's the topic in itself, and I think we could end up with a session to kind of deal with that. But I guess I'll just take that quickly. I think the way the situation seems to be evolving, and the press note 3 in its current form stays as it is. Further formal guidance from the government has come from the government so far about its applicability to AIFs, foreign to AIFs. Very clearly, the messaging seems to be that there is a concern with the funds, not just the control, but also funds coming from the neighboring jurisdiction. And to that extent, as it stands today, I think our advice to the client has been, even though technically the AIFs are not covered as a part of the press note 3 restriction, in practical terms, we have seen some of the AIFs face this challenge when they do their filings with the with the AD, and they have been asking for certain undertakings of compliance with PN3. So I think we need to wait for that, but we also are hopeful, and I think IVCA has been at the forefront in terms of representing the interest of the stakeholders here, and the government seems to be giving patient here to kind of ensure that there's no kind of hindrance created for a flow of capital, foreign flow of capital. But I think that we would need to wait for further FAQs coming in this regard. Yeah. We have one more question that we can address. Yeah, I think it's similar where there are documents being executed during lockdown. I think, and the question is, has the attractiveness of India kind of increased as an investment destination as a result of the pandemic? Obviously, many of you will be more equipped to kind of respond to that. At least from our end, what we see, that there is clearly an increased amount of opportunity, and I think especially with the way the things are evolving, with the government push for localization in some sense, and creating opportunities on the ground. Especially, we will see some sectors where India will become more and more attractive, and we are starting in infra sector. We are seeing good amount of interest coming in on the renewables and others from institutional investors. So we will see that. I think venture capital seems to be again looking attractive for India, and I think you might see that trend at least in the near term, with a significant amount of opportunities being created for startups and other early stage investments. So that may be the other area where you might see India becoming relatively more attractive, and I think with not just in its own right, but also with a certain amount of recalibration that the world will do in terms of its asset allocation. I think India should be well placed to kind of benefit out of that. So I think maybe, I mean, there are other questions, but I think being mindful of the time here, I think I'd like to thank first of all the both Vivek and us for sharing their time, and also more importantly all of the participants over here. Note, I mean, we would be happy to share the presentation. So, please feel free to drop us a line, and we would be happy to share that. And maybe we'll distribute it across some participants here. And yes, we would love to kind of also get your inputs on the session. And I think with that, I would like to close the session here. Thank you very much.
Thank you all. Have a good evening.
Okay.
Thank you very much.
Bye-bye.